I am.
Hello everybody,
Yep.
and welcome to today's online event at the Florence School of Banking and Finance. I'm Nicholas Barrett and I'll be managing this seminar from our Florentine HQ. Now, back in November I interviewed Forsten Couple for our YouTube channel. He works at Ontario University. Back then we discussed profound misunderstandings regarding the expected implications of capital requirements on banks' risk-taking and leverage. So we are very glad today to be joined by Enrico Perotti from the University of Amsterdam and the Amsterdam Business School. And he is going to be shedding some light on economic and regulatory challenges of capital requirements in today's webinar. Now, as part of the webinar, the risk absorption potential of equity, bail-in debt, and contingent convertible debt instruments will all be explored. Now, below my head, there's a chat box where you've all been saying hello, so hello back to you, and you can use that for any comments and queries about the format and Adobe Connect, which we're using today, which we're kind of new to as well. So it's a learning process for us too. Now in the bottom right-hand corner, there's a big Q&A box. And any time during the webinar, you can ask a question there. And then after Enrico's finished his presentation, in about 20 minutes, we'll come to those questions. And we'll try and answer as many of them as we can. If you want more information about the Florence School of Banking and Finance, you can visit our website at fbf.euy.eu. And we look forward to seeing you there. And I will be back in 20 minutes to take your questions. But for now, Enrico, the floor is all yours.
All right. Thank you to everybody for being here. Thanks to the Florence School for providing this great platform. I see actually on the attending list of people, many researchers and regulators I know. Welcome to all of you. Thanks for attending. I'll be interested in your feedback. This is the first of two seminars. I was introduced as presenting the notion of how the role of risk absorption in capital buffers and the sort of further role the capital has, and why actually it is important to evolve from a sort of static view of risk and risk absorption to a more dynamic view. That's the lesson that we should all have learned from the crisis. So today is going to be short seminar, but hopefully getting to a core point. And in a week, there will be a seminar in which we go further on analyzing the role of contingent convertible debt in risk absorption, the regulation, the characteristic, the contractual impact, and some of the evidence about what markets are doing. But let's start with very basic first point. First of all, leverage. Leverage is about multiplying the effect of a force, and depending on where you position the fulcrum, you can sort of transfer more and more, if you want, energy into an amplifying movement. That's a bit of a boring way to put it, but leverage is important in banking. Point is, what banks do, for other companies, debt is a form of financing. For banks, debt is a product. Banks, part of their product is their liability. They mobilize savings that would naturally not be gladly invested in risky stuff by promising immediacy and safety. And therefore, part of their product is debt. And so naturally, banks will be leveraged because that's sort of what they issue. Now, that's sort of the obvious point. But at some point, leverage can be excessive. We've seen it. And at what point do we think is excessive? Well, you can think of a micro explanation, which is that the individual bank may be so leveraged as to essentially represent trouble, in the sense that it won't be able to absorb all losses. It will transfer some of these losses to someone else. And when that happens, obviously bankers start to have poor incentive. So at the individual bank level, excessive leverage can have additional effects on risk. There is also a novel concept that we are more aware of now than before, which has to do with correlation. Essentially, when at the system level, when overall leverage is so high, bank distress becomes correlated, and even independently from the asset side, the liabilities, vulnerability become much more correlated. And then you move essentially to systemic risk, a system where individual shocks can be propagated through the bank financing channel. So that's fine, that's a working assumption. So if indeed banks are potentially a source of risk for so many, they have to be able to bear the risk that they are taking as much as possible on their own strength. And that's why we have capital regulation. Capital regulation is the modern foundation of bank regulation. That's not what it used to be historically, but certainly since the Second World War, we have been focusing on capital. Why do we focus on capital? Well, the overwhelming view among regulator and the general public, and to some extent also among those who wrote Basel III rules, is the buffer view. The buffer view essentially takes the view that the banks have to be able to absorb risk and not let it spill over. So they have to have their own internal buffer. Risk is something that just hits us from the outside. We don't need to understand where it comes from. All we need to do is to have buffers. And the ultimate goal then is, of course, to avoid disruption and to protect taxpayers. So that's a very certainly true view of what capital also does. And it is certainly correct. Now, however, there is something more than that. There is a second view, which some people find a bit pedantic and not so important. On the other hand, for researchers, it was long a belief that this was neglected. And I think the crisis has vindicated the notion that treating risk to be exogenous is actually a very poor assumption and certainly very bad guidance for regulation. So the incentive view essentially introduced risk as a choice. The people in the banking sector, among intermediaries that make decisions about risk, will be influenced by the structural payoff. And what we know very well from originally corporate finance and contract theory is that as any firm has more leverage, the conflict of interest starts to increase between essentially shareholders and creditors, because creditors are bearing more and more of the risk. And so the temptation to create risk at the level of shareholders becomes very strong, particularly since the shareholders will enjoy the upside, while more of the upside becomes very high, that this becomes an acute problem. So while you have that in good time, the high leverage induce the temptation to gamble even further for risk shifting, there is also the subsequent effect that having created too much debt or have lent too much may create debt overhang problem, which is actually another side of the coin, actually the same problem of the risk transfer. Now, this view, the incentive view, just say, okay, there is much risk that is exogenous, but an important component of risk is actually resulting in human choices. And so when you have more capital, you're moving away from this sort of area of danger of high leverage, and therefore the incentive improves and risk falls. Now, you may have heard this. Let me ask you to sort of impulsively answer this poll. I'd like you to essentially answer which view you think is in the end most useful. It's not about being right or wrong. In some sense, both of them are right. But I'd like to have a sense, because I've done this more often, of how the audience thinks about that. And I'll make a prediction in my head about how the poll will go. I'm not going to tell you, so then for sure I will be right. So let's see. I'll wait until we get about at least, I don't know, 40, 50 votes, and then we discuss the result. Fascinating. So again, this is not about being right or wrong. They're both in some sense right, but how relevant it is. I mean, some people think that economists sometimes or academics get a bit pedantic, you know, looking for secondary effects, how important really is, or what really matters. Okay, the poll is closed. I see with some pleasure that well, first of all, it's a close call, so we're almost 50-50. There is a very slight advantage to the incentive view, which in my view represents maybe not a surprise given the people that sign up for this are probably more exposed to this question more often. So let's go back to the presentation. So I'll try to argue that although the buffer is a very good way to represent some of the benefits of capital, they're really so insufficient to understand what we need to do in order to contain risk. Let me start first by reviewing the facts about legislation, and then ask essentially a question to which we need to have an analytic framework. So under Basel III, we have moved to higher level of minimal buffer. The core tier 1 capital is going to be only equity, exclusively equity, which is a good decision, 4.5. There is another 1.5 additional tier 1 buffer on which you can have something that is equity-like, but does not need to be pure equity. In particular, contingent convertible debt under some condition can qualify under for additional tier 1 capital. So that is actually very important. This is granting to this new contract a very critical role potentially for for an essential requirement that banks have to satisfy. We'll talk more extensively next week about those conditions. But what is important essentially is that CoCos have to have enough equity content, even though initial issue is that. The additional buffer that are also might be mandated, certainly for SIFI, for the very large institution. And there is an increasing recognition that even when you impose some equity requirement, that means that there is, maybe 3% of unweighted risk assets are covered by equity. Still 97% of the balance sheet is funded with debt. So maybe it does matter what kind of debt we have, right? So there is this idea that especially for large banks, the one that time and again we end up not being able to let close down, they need to have a buffer for debt that might be wiped out in case they approach distress, so that we don't, taxpayers do not need to sort of pay for it and everybody hold their breath. What is really important here is the legal change that took place that has essentially enabled to wipe out the value of debt without going through the process of private bankruptcy law, which is the old system the banks were subject to. It was a very primitive construction because obviously you do want the bondholders to take a hit, but the only way you can have a bondholder take a hit is that if you declare the bank bankrupt, which for a bank is pretty devastating, and certainly for the system as a whole. So the key is we have a new resolution framework that will become operating at the moment where the bank is deemed to be in need of recovery or resolution. And at that point, it will be possible to sort of deleverage the bank directly by essentially taking away any debt claim. And that's bail-inable debt. Now, this applies in particular for the largest bank. Now, the minimum buffers will be 16% of risk-weighted assets, loss absorbing capacity. That, of course, includes the Tier 1. It will increase to 18%. Let's remember these are risk-weighted assets, so it's a bit less impressive than it sounds. So again, it has to be Tier 1 or something that can be written down or converted in equity. And it's clear what the goal is. The goal is this bank is too big to be closed down. It will continue to operate in resolution, but thanks to the new directive, an EU directive, there will be essentially a resolution. The European Resolution Board will take over, and it will sort of take the necessary assignment of losses. Now, it's essential that, therefore, this bank keep enough loss-absorbing capacity by the minimum debt. If they fail to maintain this level, that will create essentially an obligation to make no payment whatsoever of a discretionary nature, therefore, no dividend paid to shareholders. Also, no coupon payment that might be discretionary, such as the one on CoCos debt and on preferred stock. All right. Now here is a question. Let's think a moment of the buffer view. Under the buffer view, bail-inable debt absorb losses, just like equity. They take the same hit. So from the point of view of protecting the taxpayer, the instruments are equivalent, right? Whether these people lose or that people lose in the resolution, it doesn't matter, right? So essentially, the two instruments must be equivalent then. What's the difference? So let me ask the poll. Would you say, and this is just pure logic since you thought about the buffer view, that it's equivalent? Is it equivalent to a bail-inable debt to have equity? Remember, they have exactly the same buffering effect. So, what's your view? Please, let's take a quick poll. All right, numbers are running up. Very interesting. Now, you seem to have a strong view, actually. This is very interesting. The overwhelming view is, I think we can close the poll at this point. The overwhelming view is that it is not equivalent. Now, I wish I could ask you why you think it's not equivalent, but I'm going to show you why it is. And what is really going to be essential is the difference between endogenous and exogenous risk. If risk is completely exogenous, and you just have to be buffered by sudden shocks, well, who cares whether you're using plastic or rubber? I mean, it's all the same. If you, on the other hand, are interested in a world in which you expect people to respond to risk incentive and create eventually risk, then it matters. So it's only in the static buffer view, let me tell you, that the bail-inable debt will be equivalent to equity. In general, the intuition here is that bail-inable debt has this feature. Until default, it is debt. It will stay debt. It's never pretending to be equity or anything else. Only on the moment default, it will take the loss. Fine. That means that until default, it is still serving for leverage. So it has the effect of multiplying the sort of effect of any shock on equity. And so, once again, until default, the presence of this bail-inable debt will give incentive for risk-taking. Because, as you understand in the risk-shifting view, what is essential for a highly leveraged institution is that high risk implies larger losses for creditors, but also larger gain for shareholders. So what we understand is that at the moment where institution become too leveraged, the quality of the decision making deteriorates because there is a preference for risk, even at the cost of literally less valuable investment. So I think sometimes we need a picture to understand what's the difference between having something that converts into equity before trouble and something that essentially will, until the last minute, remain to be strongly having a strong multiplicative amplifying effect. Effect of leverage is at the amplification. So let's move quickly now into an example. So imagine we're going to compare two banks and two choices. Case one is an extraordinarily well-capitalized bank, 20% equity, risk unweighted. And he faced the choice of taking either safer or some more risk. In the other case, a bank that has exactly the same risk absorption capacity, 200 out of 1,000, but 3/4 are represented by bail-inable debt. Okay. Let's think of what the choices are. So imagine that you can invest at 3% for the sake of simplicity. Let's have it safe. So final assets, if you choose this kind of configuration, will be 1,030. The second option is a less attractive one from the point of view of rate of return. It's risky, and it yields 2%, with essentially either 12% up or minus 10%, with a 50% chance. All right. So as you can see, the choice, one of the choices is better than the other. Small error in the slides. The safe choice is a 3% return. The other is 1% return. Now, of course, a high equity bank that internalized the whole distribution of return, so it will decide, like you will, and I will decide, we won't do something that is risky and has a low return. So it's easy to show that in this example, a 3% rate of return levered 5 times, because that's what leverage does, will give you 15% safe return. If you go for the risky, well, you will, of course, also multiply by 5 the upside, which is great, but you may lose 50%. And overall, the return is only 10. It's lower than the other one because by construction, it's just an inferior investment choice. So the high equity bank will choose the safer choice. In this example, the debt is always riskless. Important. We'll come back to this. Second case. All right, now we have a bank that has 5% equity, but it has a buffer in bail-inable debt. The safe asset choice, well, gives a 60% rate return. That's because leverage is 20 instead of 5, so not much changes. It's quite attractive. But the risky choice is even better now, because in the upside, the shoulders make out like bandits. You have a 240% rate of return, which is 12 multiplied by 20. That's quite spectacular. Of course, you may lose everything as well. Now, here is the point. When you lose everything, there are even more losses to be had. Some of these losses are going to the bail-in debt. So the shoulders here are not bearing all the downside. So what you can see, obviously, is that the choice will be the risky choice. And this is in spite of the fact that the buffer review should be satisfied with this arrangement. The two things are absolutely equivalent in terms of risk absorption. They are not, however, in terms of risk incentive. So, as the slides say, the bail-in debt may cushion taxpayer, but it still leverages the upside. And so it fails the test of being an instrument thought for preventive purposes. Yes, it has an exposed benefit, but ex ante doesn't help. Now, in reality, I should also say that for all fairness, that when the bank issues this bail-inable debt, and the bail-inable debt is risky because people anticipate that there will be risk, that debt will be priced, at least to the extent that there are no other bailout possibilities, and therefore the shareholders will, to some extent, suffer the consequence of creating risk. Now, of course, I could have taken a distribution in which when you take more risk, you may end up wiping out not just the bail-inable debt, but affect debtors, depositors as well. But in any case, you could say bail-inable debt is a big improvement anyway, because it means that the cost of potential default are going to be somehow priced and borne by private parties. Remains the fact that when you look at the overall system, whether the shareholders bear it or the other one, it is better overall exposed to have a system with maybe the same risk absorbency, but also less leverage, at least over time. Now here is where CoCos comes into play, and this is going to be the subject of the next seminar with more focus. So essentially, the contingent convertible debt is a very strange form of convertible debt. Normally, convertible debt is a construction in which the investor gets a bond, and then he gets the option to convert in equity. So it's worth more than a bond, because there's additional option, and therefore the yield is lower than conventional debt. But contingent convertible debt designed for banks is different, because you have a bond minus the option to convert, which means someone else would decide when to convert. And that means that this form of debt is more expensive, because you have, of course, you have to pay for the option you're giving someone else. The option is exercised automatically, in principle. As we'll discuss next week, it's far from being a completely automatic process. But in principle, there is a trigger that will activate the conversion of the debt into equity, which will lead an instantaneous devaluation, deleveraging of the bank, and therefore restoration of incentives. So in this sense, it is something between debt and equity. It's a hybrid form. How much better it is than debt depends critically on the quality of the trigger. So when it is that it will become equity, because essentially there will be circumstances when the bank is too highly leveraged, when it's essential to restore incentive. So the more precise is the trigger that will diminish leverage upon reaching such a dangerous circumstances, the more effective is the instrument. Upon conversion, leverage is diminished either by eliminating parts of the claim or by converting to equity. Interestingly, there is a very surprising development in that context, in which so-called debt write-off, principal write-off, CoCos are becoming much more popular, and quite probably will become the norm. We'll discuss that, why is the case. It's interesting to also think about whether one system is better than one design is better than the other one for the purpose of risk incentives. So that's all issues that deserve more attention. In general, the key point is that if the trigger is set up at a very high level, which means that when things start to deteriorate, the trigger is hit relatively soon, it means it has more equity content, essentially. And so obviously it's better. But it's better not necessarily in a risk-absorbing sense, because it would be risk-absorbing anyway. It's actually better from an incentive point of view. If conversion occurs while the bank is still operating, and that's when it still matters, because it's the moment at which deleveraging can have an effect of risk incentive, and so dynamically influence risk creation. Well, at default, CoCo may take on losses just like any bail-inable debt, but that's sort of the least important part. The really big challenge to understand what CoCo can contribute is to what extent it is actually doing more than that. So I think this will be for the next class. Well, let me draw some conclusion and take your question. So bail-inable debt has the same loss absorbing capacity in equity, but it creates essentially the same risk incentive that normal debt. And so in that sense, it's dominated, not that we doubted it. The emphasis on bail-inable debt reflects the urgency the regulator had in trying to avoid further losses that become socialized. But somehow, if you can read the entire EU directive on bank recovery resolution, and appreciate just how little attention has been given to the whole question of going concern. So, okay, it's fine. The bank is in trouble. Losses have to be borne. Let's assign the losses. But let's do more than that. This is an old concept view, buffer view of a risk. Let's not just absorb losses. Let's make sure that we actually prevent them. So essentially, key point is what is unique about contingent convertible capital is the ability to convert before default as going concern. We'll come back to this question in the next session. Good. Now, I think it might be the moment for me to have some question. I can see that a few have been selected. So let me turn to them. So let me look at the first question from Mikhail. So the first question is, who are we assuming to be the holder of debt? Wait, I'm sorry. I'm not starting from the start. Let me start with Paul. Does the analysis applies to CoCo are converted in advance of resolution and when the conversion terms are unfavorable to shareholders? Okay, this is a question I would prefer to wait until next class just because I haven't described different characteristics of CoCo. Let me say one thing. There is no CoCo outstanding there in which conversion does not basically favor shareholders. There is, it's almost impossible to have conversion of CoCo in a form that damages shareholders. There are even legal reasons why it's sort of hard to issue. In any case, it might be theoretically possible to issue, but none of them outstanding seems to have that characteristic. Now let's run through them. The question: if it is it bail-in debt intended for certain type of informed investors, like institutional investor who can better evaluate the risk? Well, I think that's certainly appropriate. I mean, we have to remember that when we see that on the market for these bank liabilities, there is some distress, people start talking like there's something wrong with this form of financing, but it's quite the opposite. Finally, we have some bank liability that are somewhat risk sensitive. You know, we bail out everybody during the crisis. So I think that moving to the next phase is one in which we first make sure that the private sector bears the risk it may create, and the losses are borne by investors opposed to taxpayers. So yes, I expect indeed that the bail-inable debt will be chosen by bond investors that have this sort of orientation to deal with risky debt. Interestingly, it looks like CoCo will also go that way. You can think of a CoCo as being attractive to both investors in equity and debt, But the truth is that it looks like it's that investor who will become dominant. But that's maybe too early to fully say. Right. Let me come back to Mikhail. So, Mikhail, who are we assuming to be the holder of the debt? Same or different stakeholders? So the question is, will debt holders be the same as shareholders? I don't think so. I mean, in my experience, I've organized a couple of workshops on this very subject, including one in which we had a very extensive market participation. We had a Swiss National Board team describing the new program. It was done at the Dutch Central Bank. I can tell you that the investors are quite segmented. I have a sense that people invest in CoCo are overwhelmingly debt people. And what actually, that's fine, but what is actually very surprising is how segmented the market is. Debt people don't think like equity people, and they don't want to think as debt equity people. Now, let me look at the next question. Juan Pedro. Leverage can also endogenously affect effort to avoid bankruptcy in a model with moral hazards. So I think what you're saying is that there might be a case in which you will do all sort of destructive things in order to postpone bankruptcy. That's a context in which that is indeed the case. I mean, when you have a high leverage, there's so strong redistributive effect that depending on circumstances, you may want to accelerate. Actually, accelerate bankruptcy. I think fundamentally you're right. The orientation of shareholders will always be to postpone as much as possible. It is possible to have something called strategic default. But strategic default is the case in which you could have avoided bankruptcy, but you didn't because it would cost you too much to avoid it. And again, the key determinant whether you would find yourself in that perverse situation is leverage. Once leverage becomes excessive, the weight, the overhang, the burden of the old debt will essentially suffocate the more healthy forward-looking vision. Another question. Are capital and liquidity rules primarily designed for corporate banks? What about non-joint stock banks? Ooh, that's a good one. So in Holland, one of the first CoCo ever issue was the Dutch Rabobank issue, which was for a bank that had no equity. And what was interesting was that it was issued as a sort of principal write-off. And that is exactly the format that some institution that has no equity can take. So in that sense, actually, it's quite interesting instrument, sort of. There was some problem in the design of the Rabobank issue. Curiously enough, upon conversion, some amount of the capital would be paid back in cash. So, but anyway, let's not get into that detail. But so the answer is yes, it is possible indeed to design in a way that satisfies the need of non-corporate banks. All right. John asks, assuming the market for bail-inable debt is perfect and it's actually fairly priced, not the case that the choice of the risky asset would increase the cost of funding through removing incentives to invest in a risky asset in the first place? Well, there is an ex ante and ex post. So John, you're right that in some sense, if the alternative to equity were fully priced, then the general problem of bank capital ratio would be solved. You're assuming that essentially the bank can choose to issue equity or bail-inable debt, but both bear all the cost, and the shareholders, when they issue, suffer the cost that will be incurred. So if 100% of the cost created by risk will be inefficient risk choices, will be borne by investors, by shareholders, then they're not going to do it, right? So, but you're assuming a lot. You're assuming essentially that the bank's liability are fairly priced. Let's be blunt. The problem with bank equity is not that it's expensive. It's certainly a risky claim, so it's somewhat expensive. The real problem is that debt is too cheap. And that, by and large, probably applies to more formal debts, including the one that, in some circumstances, they'll be built in. We'll see exactly how that works out, by the way. So I think my bias remains that there will be, still the issuance of risk-bearing debt will still be cheaper than equity. But we'll see. I might be very surprised, and I would be happy to. Okay. There's a question by Warda about holders of bail-in debt disciplining banks. Well, they certainly are going to be more alert than the holder of subordinated debt before the crisis, because those guys essentially didn't do anything and didn't need to worry about anything, because essentially the debt ended up being largely bailed out. But I think it is very difficult. I mean, basically, I do not believe that you can use debt to discipline banks quite the same way as in a corporate finance sense. And the problem is that the banks is an easily explodable object. If you apply pressure on a bank, questioning the choice that are made, the bank is a fragile construction. And so I think I'm very skeptical that you can use pressure from that per se, from private sources, to discipline banks, just because, if anything, the temptation is always to keep appearance everything is going well. And to the extent that you have a senior client, you actually are a little closer to the views of equity than some with the demandable claim. So no, I would not believe we can do much with that. Right. Several questions, some more. Okay, so CoCos may solve risk-taking if bank choice are observable. Well, I think if the banker's choice of risk were observable, that a number of things we could do. And actually, you don't even need contracts. In a sense, you need regulatory action. So I think from a theoretical point of view, it's a good point, but I think it's not. If we are in that world, the problems are not that serious. Now, Ettore asks, in terms of civil liability of the bank towards the investor, is there some difference if we operate through bail-in debt, CoCo? That's a legal question. I suspect not, but it could be that I'm just thinking in the way financial economist does, somewhat simplifying that. I think not, essentially, once you're in default, you're limited liability. I don't think so. I'm trying to think hard whether those who would have their CoCo converted into equity would have any claim. I think the answer is no. Yeah, essentially, they have agreed to the terms. So, but I'm not a legal expert. Michela, if institutional investors hold the bail-in debt, they also stronger monitor, which means the instrument could meet the goal of reducing the risk. I mean, it's possible. I've never seen it happen. That creditors, long-term creditors, monitor banks actively. They don't have immediate voice. They don't have an immediate threat. In some sense, the demandable debt, the shorter debt, is the way that there is a threat for the banks. And that was the view of Rajan and Diamond in their paper a few years ago. They took the idea of bank fragility was actually a good idea. I personally think that turned out to be a wrong path to take. I think it's somewhat irresponsible to think that you can essentially expose yourself to destructive runs for the sake of proving that you will behave. Also because, as we know, runs can be triggered by external events. They are inessential runs. There is a good literature on the fact that although there is always some fundamental risk behind runs, runs can also happen for banks that are potentially solvent. And so I think it's irresponsible to use that nuclear option for discipline. Right, let me see. Andrea. Okay, well, this is a bit a question about legal issues, so I don't have much to add. One more question. Sorry, it's behind my camera. Will introduction of bail-in debt affect bank business model, lending to real economy, or what have you? I don't know. I think what is clear is that many changes we made to legislation have made a particular business model not quite feasible. The business model, the Cowboy model, in which banks expanded madly, funding themselves with very short-term debt, expanding long-term assets very fast. I mean, let's remember the Lehman double inside in the last 3 years before it went bust. It did so by borrowing extremely short-term and investing long-term illiquid real estate type of asset. By the end, it was as large as the sum of GDP of Holland and Belgium. Now, these are dangerous models. The fact that you create more demand for backing of assets with risk-bearing securities means that at the issuance of this security, that will be discipline. What after the issuance? This is the problem of the disciplining view. I am convinced that the moment a bank goes on the market and sells long-term debt, it's asking people to make an evaluation on the risk they are taking. And so that's a moment where there is discipline. But after it's issued, that effect is lost, and certainly with long-term debt. So no, I just don't believe that bail-in about that will be, once issue, play a disciplining role. Again, I'd be happy to be wrong.
Hi, Enrico. Sorry to interrupt, because I can tell you're enjoying yourself a lot, but we have been going for almost an hour now, so we'll just take one last question. You can choose it, and then I'll come back and say goodbye to everybody. So one more question.
Right. Let me see. John is asking, given that you appear to be rather cynical at the ex-ante monitoring of banks and the corresponding ex-ante market discipline argument, what do you see as the benefit of having a TLAC requirement 16-18% as opposed to a simple equity Tier 1 requirement 16-18%? None. I think that equity is best. I think that, there is a direction in which we have not gone. If you were to require all buffers to be equity, it would require a lot of issuance of equity. And it would impose certainly a cost on existing shareholders. It would put some strain on the business models. As it is, banks are struggling to be profitable these days in meaningful ways. But yes, you could move towards a more utility construction. But frankly, I think that's highly speculative. It's not going to happen. I think that we have raised buffer as much as we could. Realistically, it's not more is coming. To be frank, I would prefer more action on the liquidity regulation front, where very little has been done. Well, little. and rather than keep insisting on more equity, because basically I think it's just highly speculative. It's just not going to happen. The resistance is too massive, and so it's not going to happen. So let me leave it at that.
Hi, thanks, Enrico. I said one more question, but we couldn't help ourselves because there's a great question from Angelos here, just asking for a quick comment on events relating to Deutsche Bank's AT1s in January and February. I don't know if you can see it.
Let's see. I understand there is a... Sorry, what do you mean I can see the question?
Yes, there's a question from, can you see it? From Angelos Deliviaras, I think I'm pronouncing that correctly. Although it's more of a question for next week, could you please quickly comment on the events relating to Deutsche Bank's AT1s in January and February?
I think the point is that there's been a lot of instability on that market. Prices have nosedived and jumped up and remain very volatile. I think there is a sign that people are learning a bit more about what exactly how CoCos work. I think the fact is volatility is a good sign. It means people are understanding it's a risky instrument. They should understand that they're risky because someone has to be at a risk. But let's be frank. The chance of I think the main reason there was instability, but I prefer to discuss it extensively next class. But just briefly, is the fact that it's not so much a question of solvency that is up. It's more the question that the Deutsche Bank CoCos suddenly look like, well, perhaps they won't pay the coupon next year, because the coupon is discretionary. The coupon, quite frankly, is just a small part of the present value, but still. And markets are sometimes a tendency of waking up and rediscovering the obvious, something they knew at the issuance, but they then forgot. I think it looks like Deutsche Bank will actually do everything they can to keep the payment, so we'll see. But I'm happy to discuss it more next week.
Yeah, great. And as you say, if you're still interested in CoCos, we will be here in the same time, the same place on March the 16th, where we'll be going into them in much more technical detail, I understand. So with that, I want to thank Enrico for a very immersive presentation and a fairly comprehensive Q&A, and I especially want to thank everybody who took part. We do this for you. We really appreciate all your participation. We love the interaction that we have with you. That's why we do this, and I thought I would just talk you through the kind of people who are coming to today's events. About a third of you are from European institutions, including the European Banking Authority and the European Commission. Another third are academics, so we have a lot of people coming in from academia, and the final third are made up of people from the private sector and other national entities. So we've got a fairly diverse range of experts here. And if you can still see the presentation, we have some other events coming up. As I mentioned, we have our CoCos webinar, which is just going to be like this one, coming up on the 16th. And then we have some residential training coming up, including an introduction to risk management and the economics of banking on the 30th of March and the 1st of April. And then we have some stress testing methods on the 26th and the 27th of April, and then we have a big conference on filling the gaps in governance, the case for Europe, on the 28th of April. So if any of those interest you, you can find out how to take part and be involved at fbf.eui.eu.
Sorry.
Go ahead, Enrico.
I'd like to add one more residential training. So we will organize in Amsterdam also residential training course under the sponsorship of the Florence School. We'll teach a course on financial regulation. Focus will be a capital regulation, liquidity regulation, and shadow banking. So it'll be largely microprudential, but looking at sort of the new emerging things. And it will be very end of November, beginning of December. And I think so you have to, again, go to the platform of the European University Institute. Thanks.
Great. Well, this was really fun. You know what? With those shape of glasses and your hair like that, I feel like I'm looking into the future when I do these webinars. So it's really fun for me. Anyway, thank you everybody who came. Right. We really love how many of you there are. We didn't expect this many people, and we hope to see you again in the future. So stay tuned, open our emails, and check our website, and we will see you soon. Thank you, everybody.
All right.